Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Enlightened investors, it is a pleasure being back with you today. I'm your host, Dr. Allen. You are the average of the 5 people you spend the most time with. Today, we'll be holding time with a man who inspires us with the wisdom of 25 years of relationship building with real estate investors through his work in construction industry. Enlightened investors, are you a busy professional engaged in the work of your calling, but have come to realize that the hope of developing financial independence has taken a back seat to the priorities of following your professional calling? If you can identify, I have good news. D. Tucker Capital is an investment company designed for passionate, fulfilled professionals like you to help you develop time freedom through financial independence built on solid, passive real estate investments. Go to our website, stevetucker.com, and enroll in the Enlightened Investor Circle. There you'll receive education and support for your passive real estate investment goals, no matter your level of investment expertise and experience. Today's guest is a principal of Mosaic Construction, one of the gracious sponsors for Real Estate Investing Abundance. For over 25 years, our guest, Ira Singer, has focused on building relationships with apartment community owners. His primary objective is to work with owners to add value to their communities through capital improvement projects that will improve the lives of the community residents and bring attractive returns on investments for their passive equity investors. Ira, before we delve into the construction side of apartment investing and why it is important for passive real estate investors to understand the basics of capital improvements to apartment investing, share a memorable experience from your formative years that helped you to be the person you are today.
Thank you, Alan, and thank you for the invitation to join you in this conversation. The time in reflection allows for me to circle back on some key moments, typically around a failure or a real big learning aha moment. And I think the majority of us learn by doing something wrong and the pain of that, so you ultimately do something better. And that is when I had my first company for 12 years. It was not run the way a business needed to be run, looking at the financials, looking at the sales pipeline, measuring things, and working collaboratively with the team. And getting out of that business, which gave me a lot of skill and taught me a lot, has really been the basis for the success that we've had in business for the last 17 years under Mosaic Construction. Not doing something well is an opportunity for learning and growth to change that, and that is what's happened. So it's a be careful what you wish for, because when you wish for something that is different than what you had, there is typically a growth and an adjustment in doing so. And in the rearview mirror, looking back, I'm thankful for the lessons of hardship and failure that I experienced in my younger business to allow me to reset my trajectory in my current path.
That is interesting how we have to fail oftentimes to really learn some of our biggest and most profound lessons in life. Boy, I've certainly been there myself. Ira, start us off with a basic view of what we are talking about when we are referring to capital expenditures.
The remodeling of existing multifamily assets is a very in-depth discussion. So I will try to keep things at a level where we're a little bit higher up looking down, because the type of asset, the location of that asset, the plan for the asset as you are now buying buying it? Is it a proof of concept where you improve a little bit, you get your rent bump, and you move on? Or is it a long-term hold? I understand the passive investor is dictated by the larger group that they're investing in. Understanding the strategy of what is the plan for the asset will allow for certain deployments of capital, certain priorities of various improvements to be slotted, all based on location, time of that you're going to have the asset, what the ROI intention is, what is currently at risk at the property. And so for me, it always starts with the outside of the building. It's not typically where the owners are focused. They're inside the units, they're inside any amenity spaces, any value spaces that are created. And that's really important on the ROI. What's more important is the outside of the building to make sure your roof, your water management and your gutters, your windows and doors, your finishes of siding or masonry, your concrete, that they're all stable. Because when you're talking multifamily, those are large repeat. So if you have a 7-building community and all the roofs are failing, you have to do them. You cannot go spend money on the inside if you don't have a weather protected house with your roof line and your water management of your gutters. And we can zig and zag into a variety of different things. If you ask the owners and the investors on your show, they would say kitchens, bathrooms, hallways, amenity spaces. That's what gets the bump. The first thing for me when you're inside the building is supreme Wi-Fi. To me, that is a must-have in a building, regardless of multi-tenant, multi-floor, anywhere in that building, because of our lives today, spending so much time inside, so many devices being operated, that world-class Wi-Fi is a must-have capital improvement. If the building, even if the building is C-class going to B or D-class going to C, it's workforce housing, everyone has a smartphone. Everyone has a tablet or a laptop. Everyone is streaming their TV, buying on Amazon. So I know it sounds very unsexy in terms of the ROI, but retention of your residents, that is a key piece. We do not work in that, but that I know matters more today than in past, as we are all spending more time at home.
Thank you for that explanation. Unless an investor is investing strictly and totally for cash flow, they are going to be dealing with capital improvements, as it's called CapEx in the industry. It's not an insignificant consideration for passive investors, but like you said, they're not going to be the one who is making those decisions. But every passive investor needs to understand where they're going to find that CapEx information in an offering memorandum, and they need to have a good handle on whether or not the syndicator's proposal is making sense, because the things that you just mentioned, roofs, sewer systems, drainage systems, windows, those are things that are not optional. But like you said, in every offering memorandum, the realtor is going to put out there, improve the cabinets, improve the lighting, improve the plumbing fixtures, and so forth. And yet those are probably not going to be the most significant expenses. And this is where inexperienced syndicators always run into problems. They purchase a property and they promise all kinds of great and wonderful returns, and they get into that property, and sure enough, the sewer system fails, the roofing system fails, and they didn't account for that.
Yeah, the capital call all of a sudden is different, and you're already in business with your syndicator. So let me speak to a way to help the listeners understand better where the opportunities for catching those things ahead of time make sense. I would suggest that the offering memorandum should fully detail out a reconstruction improvement CapEx plan, and that to prove the concept that it's accurate, the question from the passive investor to the syndicator is, are you working with the contractor helping you assess the building? Not a building inspector, not your past experience of owning 6 other assets, but really understanding the speed to market, the impact of supply chain to get those products, and then the execution of how that is going to be deployed over what period of time. And so the sooner the units are made over, assumedly, the better the pro forma is going to be with a rent bump. The sooner the roofs or the siding or the windows are replaced, you get the tangible benefit, of course, but you also get a facelift on the building. The question is, has the syndicator, the buyer, the owner operator brought in a general contractor with experience in asset class renovation value add to determine what would be a better deployment of capital based on need and strategy for the asset over the investment period? And I think that is where we bring tremendous value in coming in early. Has the owner investor been out to the property with a contractor to really identify and dial in what looks good, what looks bad, you have a strategy, high level discussion. And because it's a competitive marketplace, some people are buying assets sight unseen based on an offering memorandum. And to me, that is a mistake. In the multifamily world, it's all about the multiples. And so if you have one roof that's bad, you probably have more. If you have some windows that are failing, you probably have more. If you have kitchens or flooring or bath fixtures that are original vintage and the play is to improve and there's 60 units in the asset, that's a big investment of money. And how is it all going to be done systematically where there is not interruption from the start of the work? So having the contractor understand the timing, help budget to set expectations properly in the offering memorandum or in the conversations that they're having with the passive investor community, those are really important things to have a GC with experience in place.
That is a very excellent question. Thank you for pointing that out. Are you working with a general contractor with experience? This should be one of the first questions a passive investor is asking. And I think a follow-up question for that is, who is this general contractor, and can I, as a passive investor, investigate this general contractor? It's easy to do. Just go online and check them out, and you're going to be able to see whether or not they have experience in this particular domain. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
Well, talking about classes, give us just an overview of how classes are defined in the multifamily real estate industry and what significance those classes are going to have to a passive investor.
The great thing about multifamily is there is like a menu of selection amongst the asset classes. And so depending on your appetite and what's available to you, you can be investing in workforce housing, which typically is old and tired stock that is going to get a fairly aggressive CapEx value add plan because the kitchens and the baths are beyond their useful life, and you cannot bump anything if you buy it as is in poor condition. That also has the old and tired assets in any of the classes are going to require the most capital improvements. And that has got to be discussed because construction in multifamily is also contagious. So regardless of asset class, if you start in a kitchen and you make it pretty, the flooring in that kitchen that doesn't match the flooring in the rest of the unit, now the old flooring in the rest of the unit looks terrible. And by making your kitchen beautiful, but leaving other things that are connected to that space, you run the risk of not getting what you're hoping to get. And so it's not all or nothing. It's not all the kitchens, all the bathrooms, all the flooring, all the light and plumbing fixtures and doors and hardware in every unit. And the older the unit and the older the improvements have been for whenever that asset was improved, the greater likelihood that your capital expenditures in that asset are going to be higher. There's the workforce housing component. There's affordable housing. The benefit of that is that it's typically funded with government or other dollars, tax credit dollars. So you almost have a triple dip in the pool because your money is discounted to do the improvements. You're buying it potentially at a discounted rate because it's in bad shape, and you have the bigger upside on the backside. So it's like a win when affordable housing, depending on where the money is coming from. I can say as a parent of 3 college kids and older that student housing is big time valuable. Finding it, owning it, managing it, and holding it. There is not a real downside in the student housing marketplace. We're talking about everything from 6 flats to new Class A coming up at major universities where they've got amenities, and it's a wonderful investment. That leads to Class A in most major metropolitan cities and central business districts or urban cores where it's a high amenity-based location and they're serving a high rent resident. And there's opportunities to create other value adds there that wouldn't apply to necessarily workforce housing improvements, such as a dry cleaner in the building, a test kitchen for renting out in the building, a dog washing station, a bike room with bike rack and the ability to wash your bike, depending if there are things that don't translate across the asset classes. And so you, as an investor, a passive investor, understanding the investment play for what is going to happen. Is it a full makeover? Is it in good shape? And you're just investing to tag along on the return side because it's already an income producing asset. It is all over the board. There are certain things that always matter: the unit inside, the weatherproofing, and the beauty of the building on the outside. And so those kind of cut across all classes, but how much you spend into each asset depends on who your resident is going to be.
Good information. Just briefly here, for a passive investor looking at an offering memorandum, what should a passive investor be aware of when assessing the appropriateness of a sponsor's proposed capital expenditures? Say, for instance, they're looking at a Class C property, and what kind of assets should they be looking at in terms of capital improvements for a Class C as opposed to a Class A?
So I would say in a Class C, regardless of whether it is senior housing, workforce housing, whoever the residents are, the class is going to provide the greatest upside because the assumption is you're buying it, the operator is buying it at a discount because it's in bad shape. It's a Class C property. It's known that it's going to need value add capital improvements. The question I would ask as the passive investor is, what is the overall raise? What is that going to be deployed to fix? What is the strategy for how long they're deeming this asset to be held? Because the greater the investment, the typical longer term that the asset has to be held in order to recoup that CapEx improvement and get your cap rates. The C typically has the most need, but also has the greatest chance for the upside, for the boost in rent.
It has the greatest value add opportunities. But of course, with that greatest value add comes the greater risk, because the more improvements that have to be made, the greater risk there is for things to go wrong. And so once again, the more experienced contractor you have, that is, of course, one way to reduce the risk.
I would agree. And let me just further that point to say that construction like this in the units, in the hallways, in the amenity spaces or the common spaces, they're invasive. They're not one day. They're several days. There's multiple units being worked on at a time if it's a unit reno. And the building is going through, and the residents are going through that experience with you. And so being able to retain the resident is really more on the shoulders of the contractor to make sure good communication with the property management team is in place so the resident is being informed as to when work is happening, that expectations are being set from communications from contractor to management company to resident as to what's going to happen and when. If every message that comes out to a resident tells them a story that ultimately the contractor doesn't deliver on, it's going to create blowback to the management or the owner to say, when is this going to be over? The contractor you have is leaving a mess. He's working after hours. His materials are stored in a place that was a parking spot. My brother tripped coming in because the stairs weren't done yet. All of those things matter to the resident. The resident cares about themselves. The owner cares about raising money and making money. The contractor is the bridge between that raise of money and plan and the experience that keeps the resident happy and allows them to renew, to update their lease, because the makeover that just happened is awesome. And that's all on the contractor's shoulder.
Good points, because the renovations, whether it is going on in the tenant's apartment, it is going to affect them. There's going to be pounding and banging. That could be in the adjacent apartment. If there is roof work going on, there's going to be pounding on their roofs. If an offering memorandum is promising that an apartment that is rented to 75% capacity is going to increase to 100% within the first year, that might be a red flag that a passive investor wants to look at, because it's going to be difficult to maintain the tenants who are there while all of that construction is going on.
To that point, Alan, if the building is going to get a significant interior unit renovation, it is my experience that the owner plans for the loss of income while those units are offline getting renovated, and a decent pace might have 8 to 12 units being renovated a month that are vacant, and the contractor has 3 weeks to do the reno of those 10 units and then clean them to put them back into the rent roll. And so if you're seeing that kind of forecasting in the makeover and the deployment of capital for CapEx, you're going to be down on income, and getting renters back in at the higher number isn't assumptive. It's got to be something that the investor, the offering memorandum for this specific investment company, has proven that they are able to do that, because that is not an easy thing. Even though multifamily is a phenomenal asset, it has been the titan since 2008-9 when things were really bad in the housing market, and it continues to be a strong investment for the passive investor because everyone needs a place to live, and there's so many different classes of asset that everybody can find a place to call home within an apartment community. You still have to think, what is going to happen to the asset through construction, and what is the effect on net operating income if we are kicking people out to do the reno? Will we get them back at our higher number?
Exactly. A lot to consider. What, as a passive investor, is looking at a offering memorandum, are the major warning signs they should be looking at in terms of CapEx improvements?
That's something I can't necessarily comment on sight unseen to the specific asset. My hope is that the offering memorandum put together by a syndicator is somebody who has experience, who has run numbers, understands the rent roll, has been to the site, has a conditions report, possibly a needs assessment report, has consulted with a contractor to prove that the budget place they're holding for various improvements will work. In my current life as a contractor, pricing from our trade partners, pricing on materials, and lead time on materials have all been affected through the last year of the pandemic. Great contractors are working, and I called one of my concrete contractors yesterday for a project. He told me he is booked for the rest of 2021. He has that much business on the books. And so speed to market, and I don't know that you can determine this in an offering memorandum, but some piece of paper promising this flow of construction, this deployment of capital into the asset. Are there contractors in place already? Is it going to be done? Because if you hire your home bath remodeler to come out to your 100-unit asset and think that they're going to be able to shift from that speed and that level into what exists in the multifamily sector for renovation. Even your window replacement contractor that did your windows at your home, doing 500 windows in a 600-unit asset, going into 600 different doors and dealing with the conditions of the residents living there, because that you don't have to kick people out. You can do window replacement as a fairly non-invasive remodel improvement. And to do that, it's not the same as the same guy you would hire for your home. And so I don't know how any of that is going to translate in an offering memorandum. The conversation you and I are having is for the ears of your investor community to perk up. And if they're being approached to write a check, they have every right to ask the question about what is the cap improvement plan beyond what I'm reading in the pages? Why? Make the case study as to why. Have you spoken to contractors? For phone calls to anyone that you're about to write a check to would seem to me a fairly smart step that your investors ask the question. Assuming in my industry, in my business specifically of construction, is a dangerous and typically fatal decision, because it always costs more and you should have asked the question.
Absolutely. And there are so many ways and means to be making assumptions in an offering memorandum. Good advice. Always go back to that question of, are you working with an experienced general contractor? Ira, before we go into our last segment, share with our viewers and listeners how it is that they can get in touch with you. And you've got a screen to share with us there. So if you could go ahead and pull that screen up so our viewers can see what we are referencing there.
Sure. So let me screen share. This is the easiest way to get in touch with me. And if there's anything that's been discussed through our talk that has piqued your interest, the phone call is easy. And I would encourage your listeners to give me a call. You can find that information at our website at Mosaic Construction, email as well. We are experienced multifamily renovators. These are some of the assets we have worked on, both interiors and exteriors. I should have mentioned, Alan, that regardless of asset class, the package world, because of our lives at home, has increased exponentially. I saw something in the news this morning that Amazon is blowing away their estimates for what they thought their earnings would be. That is not the only company experiencing growth in the online shopping world. So this is a picture of a package room with a package locker system in a Class A development. And that is something to think about from the owner and management side. Where are all the packages going to go when we are remodeling the units? And flipping through, you can see some of the work that we do is highlighted here in the renovation spaces. And I do want to just speak to our Mosaic actions, which are these items here. These are things that we speak about in our company, relationships being foundational to our success. And in construction, doing it the right way and closing the loop on open items is oftentimes a tripping point for a remodeling contractor. And so we have real intentionality around anticipating needs and closing the loop on our projects. Here is our website and our phone number. I would love to hear from any of your listeners. I'm going to stop the share. And we're back to you and me.
Viewers and listeners, you know how you can get in touch with Ira, and I encourage you to do that if you are considering a passive investment of any kind in multifamily real estate. So Ira, share with us one of your most difficult setbacks, and how did you come through that time, and what did you learn from that experience?
I would say that 2008 and 2009, when the housing industry had its collapse, those were extremely challenging times to be in business. We own and operate Mosaic Construction, which does residential, multifamily, and commercial general contracting. We also have two other brands in our company. One is called Design Construction Concepts, which is a custom design build, single family residential, mostly work and boutique commercial. And our other brand is Cannabis Facility Construction, which serves the cannabis industry nationally in dispensaries, cultivations, and processing for design and build. In 2008, the cannabis industry wasn't what it is today. So we had our brands of Mosaic and Design Construction Concepts, and things were frighteningly quiet. And we made some very challenging and important decisions around our longevity and our ability to stay relevant in business that had to do with investing in our company, investing in nonprofit giving, making sure we were visible in front of our end users where they were still participating, being at charity events. And so we cut our outbound marketing and we invested in basically supporting charities, which kept us in front of people and let them know we were still there. That was extremely challenging. We had to make some team decisions related to who was staying and who was going. We had to look at our projection of our pipeline And again, through the adversity, through the challenges, we found a way through. We've always been a yes and company. We've always been flexible and adaptable to people who have come to us for needs that may not be our core of what we do every day. And because we say yes, we find that our world expands and we have a new opportunity, a new client relationship, and ultimately a new sector. We would have never been in the cannabis industry 6 years ago had one of our clients who was in the retail strip mall asset management line of real estate. They had applied for and were awarded 3 dispensary licenses for retail stores in Illinois, and they came to us. We said yes. Had we not said yes, we would not have built at this point over 40 projects in 12 states in the cannabis design build industry. Challenge is it's fearful to say yes. It's fearful to say yes to what you don't know, to believe in yourself. And at that time in 2008, 2009, the partners came together and made some very hard decisions. Thankfully, we were all aligned, and it worked out well where our trajectory and our success has continued to go up since that time. But challenges are where lessons are learned. And so that is something that I think your listeners should understand. The personal challenges, the business challenges, that is where you have a chance for transformation, reevaluation, and setting a new course. Life is sometimes a do-over, and take advantage of those opportunities.
Say yes, even when you're afraid. Good advice. Ira, imagine that you have come to the end of your life, and as you lay on your deathbed, what do you look back on your life with your greatest sense of joy, satisfaction, and fulfillment?
The relationships that I participated in across all areas of my life, from my immediate family to my lifelong friends, my business partners and our team, our trade partners, our clients. That is the fabric of my story. It's where I've taught my children the importance of asking for what you need, saying yes, investing in people, being a good listener. Asking for help is so counterintuitive. It is so important. And so my greatest joy is in the relationships that I have shared. There have been struggles, and those have also taught me, of course, through the hardship of some of my relationships. And yet, if I stand for anything, I stand for a relationship person, good communication, transparency, honesty in a industry, frankly, that is not the norm. You expect your contractor to not necessarily be transparent and upfront with the scope, the timing, the fees. That's how I was raised. It doesn't matter that I'm a general contractor versus a teacher versus anything else. I think the hallmark of success is good communication and investing in relationship, and that is what I am most proud of.
Ira, it has been a wonderful pleasure having you back on the show. Thank you for being with us today.
Thank you very much. It's been my pleasure.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.